Welcome to the Deep Dive. Today we're going straight into something pretty fundamental. Sound money.
Right.
We'll be using the Bitcoin standard as our main guide, really, to explore what makes certain kinds of money, well, last.
Yeah, what gives them staying power?
Think of it like we're trying to uncover the essential ingredients that let a currency actually do its job. Our mission, basically, is to get to the heart of what money is and why some types just seem to work better historically. The sources we have are pretty detailed, so let's jump in.
And it's interesting, right off the bat, we all use money every day to buy things. That's the medium of exchange bit.
Yeah, the obvious part.
But that's really just like the surface. Money's also super important as a store of value.
Saving up, right?
Exactly. A way to hold wealth over time, and also as a unit of account, a measuring stick for value.
So you can compare the price of apples and cars.
Precisely. And it's how well money does all these jobs that we're really digging into today.
Okay, so those three core functions: medium of exchange, store of value, unit of account. Let's start with the first one. Why do we even need a medium of exchange? Bartering seems simpler, maybe.
Well, yeah, it seems simple if you're just swapping one thing for another directly.
Like, I have apples, you have bread. Easy.
But imagine you're that apple farmer, and the baker, well, maybe he doesn't want apples today. Maybe he wants shoes.
Ah, right. The coincidence of wants problem. You both have to want what the other person has right then and there.
Exactly. And as economies get more complex, more specialized, barter just becomes incredibly inefficient. It really slows things down.
Okay, so if I'm a carpenter making tables, I can't easily trade a table directly for everything I need.
Right. Finding someone who needs a table and has the right amount of, say, flour or cloth you want, it's tough. And this is where Carl Menger's idea of salability comes in.
Sellability. So how easy it is to sell or trade something.
Pretty much. The more easily and widely accepted something is in trade for other goods, the more saleable it is. And the most saleable goods tend to become money naturally.
Got it. Salability is key. So what makes something highly saleable? What makes it good money? This leads to the idea of hardness, I think. And it's not physical hardness, right?
No, not like hitting it with a hammer. Hardness in this context is about the stock-to-flow ratio.
But break that down, stock to flow.
So stock is the total amount of something that already exists. Think of like all the gold ever mined. That's the stock.
Big pile.
Right. And flow is the new amount being produced or added over a period, say, per year. New gold mined this year.
Okay, smaller trickle.
Exactly. So the stock-to-flow ratio compares the size of the existing pile to the rate of the new trickle. A high ratio means the existing stock is huge compared to the new flow.
Which means it's hard to significantly increase the total supply quickly.
Precisely. That's hard money. Even if demand shoots up, you can't just flood the market with tons of new supply overnight and crash its value.
So gold is the classic example. Centuries of mining, relatively small new amounts each year, high stock to flow.
Exactly. And that's the opposite of easy money, something with a low stock-to-flow ratio.
Meaning it's easy to produce a lot more of it quickly.
Right. And that's where the danger lies. If money is easy to make, whoever controls its production can just inflate the supply.
Watering down the value, like you said earlier.
Yeah, exactly like adding water to juice. Each unit becomes worth less. Your savings get eroded.
And this affects how people think about the future, doesn't it? The source mentions time preference.
It really does. Sound, hard money that holds its value tends to encourage a lower time preference.
Meaning people are more willing to save and invest for the long term.
Yes. Because they trust the money will still be valuable later. Easy money, constantly losing value, pushes people towards a higher time preference. Spend it now before it's worth less.
Makes sense. Less saving, more immediate consumption. But hardness isn't the whole story, is it? People have to actually, use it.
Absolutely critical. You need acceptability. Network effects.
Like social media. The more people on it, the more useful it is.
Exactly the same principle.
Right.
The more people and businesses accept a particular form of money, the more useful and valuable it becomes for everyone else. We naturally tend towards the money that's most widely accepted.
And when one form of money becomes widely accepted, that lets it fulfill the third function unit of account.
That's right, because now everything can be priced in terms of that money. It becomes the common yardstick.
You can compare costs, calculate profits, make investment decisions.
It enables complex economic calculation, which is fundamental for specialization, for markets growing, for investing wisely.
And easy money messes this up too.
Big time. If the value of your measuring stick is constantly changing, how can you accurately measure anything? It makes rational economic planning much, much harder, creates distortions.
Okay, so we've got the functions, the sound versus unsound idea. Let's look at some history. The source mentions primitive money, like rice stones.
Yeah, the race stones on Yap Island are fascinating. Huge limestone wheels. Their value came largely from how difficult and dangerous they were to quarry and transport back to the island.
So again, it was about the difficulty of production, the low flow.
Right. But the source points out that when European traders arrived with more advanced tools and ships, they could bring in new stones much more easily.
Increasing flow.
Exactly. And that ease of production undermined their value as money. A classic example of how increasing supply can destroy a store of value.
So that didn't last. Then we get to metals. Gold, silver, copper. These seem to stick around much longer.
They did, and for good reasons. These metals just had great inherent properties for being money. They were highly saleable.
How so? What made them saleable?
Well, they were durable. They didn't rust or decay easily, so they held value across time. They were relatively scarce. They were portable, especially gold, lots of value in a small space.
Good for carrying around or shipping.
And they were divisible. You could break them down into smaller units for smaller purchases, but also combine them for larger ones, saleable across scales. And they were fairly uniform and recognizable, good across space.
And then coinage came along, stamping them into standard units.
Right, which made things even easier. Standardized weight and purity, less need to weigh and assay every transaction really helped trade flow.
But even metal systems had problems, trying to fix ratios between gold and silver, for example.
Yeah, bimetallism or trimetallism was tricky. Market values fluctuate, but governments tried to fix ratios, leading to imbalances. And then there was the constant problem of debasement.
Governments or even individuals cheating the system.
Exactly. Clipping small bits off coins or mixing in cheaper base metals while trying to pass the coin off at face value. It's basically inflation by another name, a persistent temptation.
Which brings us to the gold standard era. Why did gold specifically end up on top?
Primarily, its superior durability and resistance to decay. It's chemically inert, basically. It made gold the most reliable store of value across very long time horizons. That fosters stability, that long-term planning we talked about.
And the source links this to flourishing civilizations, like Rome.
Yes, the Roman Golden Age, think Julius Caesar, saw the widespread use of a pretty stable gold coin, the aureus. This coincided with massive economic expansion.
But then
Later emperors, like Nero, started significantly debasing the coinage, reducing the silver content, for instance.
creating inflation.
Economic chaos, undermining trust. The source argues this monetary decay was a major factor in Rome's eventual decline. Stark lesson.
But not all empires went that way immediately. Byzantium had the Byzant.
Right. The Eastern Roman Empire, Byzantium, under Constantine, introduced the solidus, later called the bezant. And crucially, they maintained its gold content with remarkable consistency for centuries. Over 1,000 years, really.
Wow, a millennium of sound money.
Relatively speaking, yes. And that monetary stability is credited with providing a foundation for Byzantium's long economic life and resilience, especially compared to the collapsing West.
So political will and discipline seem absolutely essential. But even the gold standard wasn't perfect. It had vulnerabilities.
Oh, definitely. Moving large amounts of physical gold around is costly and risky. So naturally, people started depositing their gold in banks and trading paper claims, banknotes, instead.
Okay, more convenient.
More convenient, yes. But it led to the centralization of gold reserves in banks and eventually central banks.
And centralization creates temptation.
Always. Banks and governments realized they could issue more paper notes than they actually had gold backing them. They could create credit, essentially monetizing their own promises based on the network using their notes.
So the system started relying on trust again. Trust that the notes could be redeemed for gold.
Exactly. There wasn't a built-in mechanism to force governments to stick to the gold backing. It relied on convention, public vigilance, maybe fear of bank runs. But ultimately, that trust could be broken.
Which leads us neatly into the rise of government money. Fiat currency. This is a whole different beast, isn't it?
Totally different. Commodity money like gold has value in itself. Fiat money is, well, basically irredeemable government paper or digital entries now. Its value comes from government decree. Fiat means let it be done, and people's willingness to accept it.
But the source makes a really critical point here. Fiat didn't just appear fully formed, right?
No, and this is key. Historically, these government currencies gained their initial acceptance and saleability because they were promised to be redeemable in a commodity, usually gold or silver.
Ah, so they piggybacked on the trust established by the older system.
Precisely. Even today, the source argues, no purely fiat currency exists in a total vacuum. Central banks still hold reserves, gold, yes, but also other major fiat currencies which themselves have some maybe distant historical link or current reserve backing involving gold.
That's fascinating. It wasn't a clean break.
Yeah.
So what did cause the big shift away from gold-backed systems?
World War I was the massive trigger. The sheer cost of the war was astronomical. Governments needed to spend far beyond their gold reserves.
So the suspended redeemability just said, you can't get gold for these notes anymore.
Exactly. It allowed them to print money, essentially, without limit to finance the war machine. This broke the main constraint of the gold standard and really kicked off what the book calls monetary nationalism, each country managing its own flexible currency.
Were there attempts to put things back together afterwards? I seem to remember reading about Bretton Woods.
Yes, there were efforts. The 1922 Genoa Conference already hinted at moving towards key reserve currencies, the dollar and pound sterling alongside gold. Then Bretton Woods, after WWII, tried to create a system of fixed exchange rates.
How did that work?
The US dollar was pegged to gold at $35 an ounce, and other currencies were pegged to the dollar, so indirectly linked to gold.
Sounds complicated to manage.
It was. It was essentially trying to centrally plan the global monetary system. And like most central planning attempts, especially on that scale, it faced huge internal contradictions and pressures. It eventually collapsed in the early 1970s when the U.S. officially suspended the dollar's convertibility to gold.
So once that gold anchor was fully cut, governments had even more freedom to manage or mismanage their currencies.
Pretty much. Fiat money made it much easier politically to finance the expansion of both warfare and the welfare state. Governments could fund spending through inflation printing money rather than just relying on direct taxation, which is often unpopular.
So a hidden tax, in a way.
That's one way to look at it, yeah. The source provides data showing how broad money supplies have grown significantly across many countries over the decades since Bretton Woods collapsed, often faster in developing economies, leading to higher inflation there.
Okay, but if fiat has these potential downsides, inflation, government control, why is it still dominant everywhere? Why haven't alternatives taken over?
Well, governments have several powerful tools to maintain their currency's dominance. First, taxes. You generally have to pay your taxes in the government's official currency. That creates a baseline demand.
Okay, forced demand.
Then there's control over the banking system. Regulations usually favor or mandate the use of the national currency. Legal tender laws often restrict or prohibit the use of alternatives for settling debts.
So a network effect reinforced by law.
Exactly. And as we mentioned, central banks still hold significant gold reserves. They don't usually let you redeem your cash for gold anymore, but holding that gold provides a sort of implicit backing and allows them, if they choose, to intervene in markets, perhaps influence the gold price, and protect their monopoly on money.
It's a multi-layered system keeping it in place. But it's still vulnerable to government actions, isn't it? The source mentions India's demonetization.
That's a powerful example. Overnight, the Indian government declared certain large banknotes invalid. It showed how quickly the usability of government money can be changed by decree.
A stark reminder of who's ultimately in control.
Yes. And as money becomes more digital, held in bank accounts supervised by governments, the potential risk of controls, freezes, or even confiscation arguably increases, especially in crises.
Okay, so we've seen this whole historical arc. Barter, metals, gold standard, fiat. Let's zoom out again. What are the really big picture consequences of sound versus unsound money for society?
They're huge. Really profound. Sound money stable value, reliable unit of account, is presented as essential for rational economic calculation, for accumulating capital, for long-term planning, for businesses to invest confidently.
And for individual freedom, the source argues.
Yes, by providing a way to preserve wealth outside of potentially inflationary or confiscatory systems. It fosters that lower time preference we keep coming back to, encouraging saving, investment, thinking beyond immediate gratification, not just in economics, but potentially in culture, ethics, social structures too.
And the flip side, unsound money.
It encourages the opposite, high time preference. Spend now, borrow heavily, consume rather than save. The source even links it to environmental issues, like farmers depleting soil because long-term investment doesn't seem worthwhile if the currency is unstable.
That's a really broad connection.
It is. The Austrian school perspective, which heavily influences the source, emphasizes that sound money emerges from the market, not government decree, and that an appreciating currency, which sound money might be if productivity grows, actually encourages good investments, while depreciating fiat money can fuel malinvestments.
Malinvestments, projects that only look profitable because of inflation.
Exactly. Things that wouldn't make sense in a stable monetary environment. The source goes even further, connecting unsound money to perpetual conflict.
How does that connection work?
Well, a few ways. It can distort trade relations, creating friction. Crucially, it allows governments to finance wars relatively easily through inflation without having to directly ask the populace for the funds via taxes.
It's hidden tax again.
Right. And the idea is that a society with a lower time preference, fostered by sound money, might be more inclined towards cooperation and long-term stability rather than short-term gains through conflict. The military-industrial complex, it's argued, benefits immensely from easily inflatable government money.
It suggested that history shows periods of progress often align with sounder money and less government intervention.
That's the correlation the source draws, yes. Connecting periods like the Belle Epoque or parts of the Roman era with relative monetary stability and flourishing arts, science, and commerce.
The influence can even extend to academia, the source suggests, how economics itself is studied.
The concern raised is whether government funding of economics departments and the central role of government in the monetary system might bias academic research towards favoring government intervention in fiat money systems, potentially downplaying the historical benefits or theoretical advantages of sound money.
Interesting thought. Then there's this idea of the bezel. What is that?
Yeah, it's a great term, borrowed from Galbraith. The bezel is basically the phantom wealth, the illusory economic activity that gets created during a boom fueled by monetary expansion, by easy credit. It feels real at the time, but it's not based on genuine productivity.
So it's like a bubble.
Kind of, but it permeates the economy more broadly. It can lead to capital being misallocated, flowing to politically connected firms or speculative ventures rather than sustainable businesses.
The source has a funny line about industries where customer satisfaction seems less important than internal politics.
Yeah, suggesting those might be hotspots for the bezel, where perceived success is disconnected from actual value creation. It's a provocative idea.
Okay, so this long history, full of challenges in maintaining sound money, it sets the stage perfectly for discussing digital money, and specifically Bitcoin. How does Bitcoin fit into this picture?
Bitcoin enters as really a fundamentally new type of potential money. We went from physical things, shells, stones, metals, to paper claims on metal, then to pure government paper or digital entries controlled by governments and banks.
And Bitcoin is digital cash, peer-to-peer.
Exactly. It aims to be a system for sending value directly between users online, without needing a bank or payment processor in the middle. Like handing someone physical cash, but digitally.
And the big breakthrough was solving the double spending problem digitally, without a central authority, creating scarcity online.
That's the absolute core innovation. Before Bitcoin, any digital file could be copied perfectly. You couldn't have scarce digital tokens easily. Bitcoin used cryptography and a clever consensus mechanism, the blockchain, to ensure a Bitcoin could only be spent once by its owner. It created verifiable digital scarcity.
Which is potentially revolutionary in a world moving increasingly digital, where traditional money is mostly digital entries and bank ledgers anyway.
Right. It offers the possibility of regaining individual control over money, separate from the banking system and government fiat currencies.
The source highlights its key properties: immutable ledger, censorship resistance, predictable supply.
Yes, those are central to its claim as potential sound money. Unlike fiat, where supply can be increased at will by central banks, Bitcoin's supply is fixed by its code, transparent, and decreases over time towards a known maximum limit.
We see data on that diminishing supply growth, and rising transaction numbers suggesting growing use.
Both are presented as evidence of its potential monetary characteristics. The supply schedule is very predictable, unlike discretionary monetary policy. And network activity shows it's being used, although for what exactly speculation, store value, medium of exchange is still debated.
What about volatility? Bitcoin's known for wild price swings.
Definitely. The source acknowledges the high volatility, but suggests it might be decreasing over time as the asset class matures and finds its footing. It's still much more volatile than gold or major currencies, though. The underlying tech, hashing, is what secures it all.
And its roots are in the cypherpunk movement. People aiming to use crypto for freedom.
Very much so. The idea of using strong cryptography to protect individual privacy and autonomy from large institutions, especially the state, is central to Bitcoin's origin story. It's an attempt to build a voluntary financial system outside of established controls.
How does it stack up against gold, according to the source? There's a difference in industrial demand.
Yeah, that's a key point raised. Gold has a significant non-monetary demand jewelry, electronics, which provides a sort of price floor. Bitcoin's value is almost entirely based on its monetary properties. Scarcity, transferability, network effects, it's a different kind of bet.
But it's proven resilient, despite attacks.
Remarkably so, the source argues. Its decentralized nature, the economic incentives for miners to secure the network make it very hard to attack successfully. It relies on consensus rules for governance, making changes difficult without broad agreement.
Verification over trust.
That's the mantra. Users should ideally run their own nodes to verify the rules and transactions independently, not just trust intermediaries. The source contrasts this with many other cryptocurrencies, or altcoins, that often have more centralized development teams or foundations, making them potentially more vulnerable, citing the DAO hack on Ethereum as an example of risks in more complex, centrally influenced systems.
So the argument is that Bitcoin's main, perhaps only proven, success is as this simple, trustless digital cash.
That seems to be the core conclusion. Providing a predictable, scarce, censorship-resistant digital asset fulfills a need unmet by fiat currencies. The source is actually quite skeptical about applying blockchain technology to solve problems beyond this core function of sound digital money, pointing out potential issues with efficiency and security in other contexts.
Wow. Okay, this has been an incredibly thorough journey, from barter to Bitcoin, exploring what makes money sound.
Yeah, it really highlights these recurring historical themes, doesn't it? The search for stable value versus the temptation to inflate or control the money supply. Bitcoin just offers a radically different approach, code-based roles, instead of discretionary control.
It really does give you a new lens for looking at the current financial world, with fiat, digital currencies, everything coexisting.
Absolutely. Recognizing the deep history and the fundamental principles at play, scarcity, sellability, time preference, helps you make sense of it all.
So a final thought for you, the listener. How does understanding this long history, these principles of sound money, change how you view today's financial system? How does it shape your perspective on technologies like Bitcoin and the future of money itself? Definitely something to mull over. Thanks for joining us on The Deep Dive.